So welcome. So we're diving into the profitability of contract management. And what I would like everybody to do is to make a list of 10 things. So if you try to take away everything, you're going to take away nothing. So find 10 things to take away of either getting prepared and or finding opportunities in this COVID economy. So we're going to be diving into specifically the financial and people side, but all areas of business as well can be applied. So I want to introduce Prince George's County Economic Development. If you want to welcome everybody.
Sure. Thank you, Russell. Welcome, everybody. We're really pleased to be partnering with Russell Teeter on this program. I'm Alicia Moran, Manager of Small Business Development here at Prince George's County Economic Development. There's my contact details. Next slide. So again, we're partnering with a number of partners to do a series of programs. And today we're really proud to be partnering with SBDC and Russell Teeter and the CEO Accelerator Program. What is economic development? We are here to support you no matter what county you're in. We're here in Prince George's County. You have an economic development person in your county. Reach out to them. They can help you with your strategic planning. They can help you with site selection. They can help you with a host of services. And for us, I run small business services. So we do a lot of training. We provide access to financing, line up meetings with banks and FSC First, our financial lenders. We also work in partnership with SCORE, PTAC, all the others that we've mentioned. So thank you so much. And we have Innovation Station, which is what you see behind me.
So if you, Eduardo, you want to welcome up everybody from the governor's office?
Yes, sir. Thank you. First of all, thank you to everybody from Russell to all the panelists and everyone working behind the scenes, including Prince George's County Economic Development, Alicia, and everyone on her team. So from the governor's office of Small Minority and Women Business Affairs, we want to welcome everyone to today's event or webinar or workshop, however you want to look at that. What I would like to say real quick is make sure you guys keep up with any of the new lessening of restrictions and things that are coming out that are going to impact how you're going to adapt as far as your business is concerned. So keep that in mind. And lastly, just pay attention to what's going to be discussed today, which is meant to help you with the keyword profitable contract management, right? So profitable means we're trying to help you guys prepare yourselves to move towards that area of profit once again. So thank you all for coming, and we look forward to today's event.
So in looking at profitable contracts in what I call this new COVID economy, the macroeconomic view, going back to maybe your college days of looking at the difference between macro and microeconomics. Macro is what's going on in the economy from a large standpoint, taking that information, looking at your situation, that's microeconomics, so that you can make strategic decisions. So thinking about the difference between good luck and bad luck. So what is the difference between good luck and bad luck? Good luck is where opportunities meet being preparedness. Roughly, and Kirk's going to get into this, is only 2% of CEOs actually get prepared. And then only half of those actually find the opportunities to convert. So that's I say it's being in that 1%. So good luck is where opportunities meet prepared. Bad luck is when obstacles meet no preparedness. So finding opportunities and being prepared for those opportunities. So there's a lot of different resources out there, but just to get an idea of who you are, I'm going to launch a couple polls. So if you could answer the question of which customer base is your primary focus in this new economy. So if you could answer this poll question, I'm just going to give a couple seconds to answer it. Okay, so we're polling most focusing on federal government, followed by state government. Okay. So looking at the next poll question, again, getting a look at who's on there, see if I can do this. Stop sharing results. Okay. Your current, oh, let me launch it. Okay, your current mode of your business. So looking at where your business is now, are you in the survival mode, where your business is based on people being in close proximity, like Disney World losing more than 40%, or you're a new business? In the recovery mode, you lost less than 40%, or in the thrive mode? Okay. So we're pretty equal on that. Pretty equal on that. Okay. So to be prepared, you need to find and use macroeconomic. Oh, let me launch it. Keep forgetting to do that. To be prepared, need to find, use macroeconomic reports from economists, from the government. So this is what you need to find and use more of. Trade, industry, or you have all the information needed to make decisions. All right. So just a couple more minutes. Okay. And one last question. To convert opportunities in this new COVID economy, what question do you need the most assistance to answer? So I'll keep going to launch it. To convert opportunities in this new economy, which question do you need the most assistance to answer? Who is spending money? The key principle is following those spending money. What is their known problem? Because it's changed. And how to best communicate with people. So who's spending money? How to solve those people's known problem? And what is the best way to communicate to those? Okay. So looking at from the macroeconomic standpoint, we have Tim with us, and Tim provided these resources. Tim, if you want to dive a little deeper.
Sure. Good morning, everyone. My name is Tim Keffer. I'm a certified financial planner with Raymond James and Associates. Griffin Wealth Management is our team here in the Mid-Atlantic. We help business owners looking to sell their businesses and help them put their team of advisors together to navigate that process. I'm here today to talk about the macroeconomic tools that you can apply, that you can research, and I think we've just provided some that'll be forwarded to you after this presentation. But I really wanted to dive in, and we did that last time at our last meeting. Today, I think I'd like to dive into a little bit about, excuse me, how to use those tools. And one of the tools is JP Morgan's Guide to the Markets. I'll move this over here. This is a slide of the S&P 500, and I think my goal today is to show just some of the different things that it's important to track when you're making strategic decisions for how to move your business forward. since the stock market to a large extent is a barometer of what the economy is doing, the first part of my presentation will be to talk a little bit about the stock market, and then the back end to talk about some specific areas of potential concern or things that you should be looking at. So this is a slide of the S&P 500. And basically, this is back to the last 25 years. And if you had $1 in 1996, it grew to $2 during the internet boom, and became $2 in 1999, 2000. And then it went back to $1 in 2002 with the bubble bursting. And then we had the real estate boom, and then we had the credit crisis. And again, that $1 became $2, became $1. And then over the course of the last, let's call it 13 years, we've seen it become $2 and $3 and $4, and then back to $3. And now we're up probably close to, if we look at it overall, over $4. And when we look at this, it gives us a sense, and kind of what I do a lot every day is, are we in this situation where we're about ready to roll over? Or go to the next slide, if you would, Russell. Are we in what's called a secular bull market? And this is that same information, the S&P 500. Again, that's the 500 biggest companies by market cap, good or bad. That's what they call the market. Are we in what's called a secular bull market, or are we in one of these lost decade situations? And this is that same slide that we just looked at before, where you had $1 in 1996, and then you had the same dollar in 2008. Well, when we look at that flat period, that lost decades, those have happened before. You see these flat areas here, but then we go on these runs from when the World War II up until the mid 60s, and then again in 1982 all the way up to 2000. And these runs last anywhere from 14 to 17 years. And they're just throughout history. And you can see we're on one right now. And the stock market coming back here over the course of the last 12 months or so is indicative of that continued run. And if you go to the next slide, Russell. So our concern is what's going to happen. Is a bear market going to occur? And a bear market is a greater than a 20% drawdown in the stock market from where it currently is, and that's that red line here. And this is a listing of the last 13 bear markets, and then there are 4 primary things that cause them. The first one is a recession. I think 10 of the last 13, and you can see here with the global slowdown of COVID. That pullback, that 34.9% pullback last year in March, late March, was due to a recession. The second one that can cause a bear market is a commodity spike, where oil goes from $50 a barrel to $150. We've experienced just the opposite here over the course of the last 5 years or so, where it's gone from 150 to 20. We're back up in the 60s, but it's nowhere near where it was in early 2015. The next one is an aggressive Fed, where the Federal Reserve is actually raising short-term interest rates. From 2003 to 2005, the Federal Reserve raised interest rates from 1% all the way up to 5.5%. And some of that was the cause of the recession that took place. And there were other factors in 2008 and the credit crisis and so forth. But an aggressive Fed was actually something that was in play there. And then the final one is extreme valuations. Just one more thing to say on aggressive Fed. The Federal Reserve has indicated that they're not going to raise short-term interest rates until 2023. So that one is not in place. The final one would be an extreme valuations. And I just lost my presentation there. Hold on just a second. Okay. So the last one would be extreme valuations in the stock market. Russell, if you'll go to the next slide. And that, to some extent, is currently happening. You can see that the mean S&P, or the average S&P here in green, but then this is the dispersion. This is how far it could go up or go down. And you see that it's very, very thick here. Let's go to the next slide. And really what an easier way to explain that is the 25-year average of the S&P price to earnings ratio is 16.69. Now, what does that mean? So let's think about Disney, for example. Disney makes $1 and their average, their price to earnings ratio is, let's say, average of all 500 of the biggest companies, good or bad. Their stock is going to trade at $16.69. Well, if you look here right now, that S&P 500, if we basketed all of those companies together, they're trading at 21.51%. And so that's a yellow flag indicating that stock prices are stretched, and they're 30 or maybe even close to 40% overvalued at this point. So that would give me as a financial advisor concern. But think about Disney. All of a sudden now they're opening up their parks, and now they're going to, instead of making $1, they're going to make $2. Well, what that does to this price to earnings ratio is it actually brings it back down closer to historical norms. If we see the economic growth numbers that they're anticipating here at the end of the year, that price to earnings ratio likely is going to come down into this 16, 17 range, maybe 18. We don't know exactly yet, but it's definitely going to come down. And you've seen the inkling of that and the beginning of that here over the course of this earnings season. Companies are making more money, and that we expect to accelerate in the second half. So again, one of the things that Kirk's going to talk about is building value and being prepared and so forth. And I think it's really important because you're going to see economic growth, and some of you may have heard me say this earlier, that we haven't seen since the GIs came home from World War II. So all four major indicators of a bear market, in our estimation, currently don't exist. You go to the next slide. Okay, one more thing I'll say about that. Every year, the stock market is down at some point 13.9%. Over the since 1950, at one point during the year, the stock market is down 13.9%. And that would be considered normal volatility. So the likelihood of us having a 5, 7, 10% pullback in the stock market is not uncommon. Historically, it happens every year. So the idea is, if we see that pullback, it doesn't mean that we're going to have a bear market. It doesn't mean we're going to go down more than 20%. All it means is that we have normal volatility, that up and down, prices go up, prices go down. And, so 5, 7, 10% is probably healthy for the market at this point, because if you saw that rocket ship that we're on right now, people are getting concerned that we need that pullback. It would be healthy if we took a breath, pulled back a little bit, because then that allows the stock market to take a leg higher and continue that secular bull market. So the next piece, go back one, Russell, apologies. Okay, so here was the trend that we were on until last year. And this is real GDP growth. And we saw what COVID did. And, to Alicia's comments, we're not back yet. We still have 8.4 million people that were employed this time March of last year, that are currently unemployed. And so, yes, we are recovering. We've seen this historical return. Usually these are U-shaped recoveries, or sometimes even double dip recessions where you get a W shape, but we're on our way back. And our expectation is, again, if you look at growth rates for the first quarter of 2021, we were at 6.4. We may be as high as 8, 9, even 10% in the third and the fourth quarter of this year. So being prepared is going to be key. Next slide. This is the global economic activity. This is the Purchasing Managers Index. And what this does is this shows you by country economic activity. So you can see Spain is still struggling. They're in the red. If you're growing, you're above 50% on this number. If you're contracting, you're in the yellow or the orange, or even the red. So Japan, Italy, and so forth. The next one is inflation. And when we look at inflation, you can see here people are concerned. We're seeing spikes in inflation, 4.2% inflation. The Fed is looking at 2.2% inflation as a barometer before they raise interest rates. Well, we were double that. The expectation of the majority of the economists out there is that we will see a short-term bump in inflation, but that will subside the latter part of next year. We're not looking like we're going to be in an Argentina or Venezuela situation. And then finally, this is interest rates. And the red line is the indicator of market expectations. So this is what the market's saying. And then this is what the Fed is saying. So everybody has them pretty low through 2023 currently. And the last thing I'll share is a case study that I saw here recently. What does the reported administrative cap gains increase mean? Roughly speaking, federal capital gains rates are looking to, with the new tax policy, to go from 23% to 24% in any year somebody made more than $1 million. So when a business owner sells their business, that is factored into to that number. It isn't too hard when you sell a major asset. So let's say a business owner sells their business for let's just use round numbers. These numbers equate on lower numbers as well, but sells their business for $20 million, and they've depreciated it over time. The federal cap rate gains rate goes from 4.6 to 8.6 million, almost a 4 million increase. Valuations are historically high, and thanks to low interest rates, there's a lot of money out there to buy them. Assume our hypothetical seller sells a bunch of risk and tries to grow profits by 10% for 3 years and then sells the business, hoping values stay high. If it all works out, he gets a 10% annual growth rate and the multiples remain high on sale price. That sale price jumps to 26 million. But the net after taxes is 15.7. If he had simply sold the business today, he would have gotten 15.4 million. So if you're thinking about exiting, you may want to consider looking at or contemplating it sooner than later, because it's going to take a lot of work and effort to get to the same net price valuation if the new cap gains rates scenarios go through. And if you're interested in talking about that, that's what we do. We help people navigate through that process and help you put your team of advisors together to make that happen. And I'll turn it back to Russell. Thank you.
All right. So, so we're going to be applying all that macroeconomic that Tim talked about of how that impacts your business, but gathering some more macroeconomic information of how to find opportunities at the state as an example. So, Eduardo.
All right, thank you very much. And again, I'm going to talk about exactly that, how to use a procurement forecast at the state level. So the two questions at the beginning, we were addressing the issue of how do CEOs prepare, right? And identify opportunities. So this is one piece of how you can do that. So if you were to go to our website, you see there at the top, gomd.smallbiz.maryland.gov. On that first page there, you'll see for procurement forecast on your upper right. So if you click on that, it's going to give you this particular portal. Now the portal for the procurement forecast, and let me just explain what that is. Every year, the state of Maryland asks, or our office, we ask all of our state agencies to send us an idea as to what they're projecting that they're going to buy over the course of the next fiscal year. Now our fiscal years are July through June. Okay, so we're probably entering now into towards the fourth quarter of that because we're at the end of that. So with that, what we do is we create this portal and then we provide this information for you guys to be able to mine information about potential opportunities that are out there that agencies are thinking about purchasing, products and services they're thinking about purchasing. So what you want to do is you go to this portal. You can do a search in 5-6 different ways, from a keyword search, such as I have here as an example, services, to by agency or procurement categories, contract value, regions, even quarters. if you want to do it that way. So when you do it, the first thing you get is you get a snapshot view in that first page. The most important thing you can do with this is after that snapshot view is you want to export to Excel. And what that's going to do is going to bring up this Excel spreadsheet that gives you expanded information that you can use to prepare and identify potential opportunities for that coming fiscal year. So what you end up seeing are things such as what the agency is, if there's an incumbent listed, you can see who currently has that contract that's going to be coming due that next fiscal year, whether there were any MBE goals attached to that, if that's if you're in one of those programs and that's important to you. Even the location within the state of Maryland where this work is going to take place, the quarter, even a little estimation as to the range. So you get a sense for the range. Now, the majority of these opportunities will most likely be 100,000 and above. However, it sometimes does include things that are below that number. So they're smaller procurements. So sometimes you'll see that. And then most importantly, at the end of that, you have information for your procurement officers, their phone numbers, their emails. So it gives you someone you can connect with about opportunities as you prepare for what's coming down the pipe. So that's just an important thing. This is how you can use a procurement forecast to help you guys with that, prepare for opportunities and identify opportunities. So that's a quick thing there, but thank you very much.
So looking at small opportunities, Kristen, you with us?
I hope so. Can you hear me?
Yeah, now I can hear you.
Woo! Okay, so last month we talked about small procurement, but today I wanted to address one of the questions that Russell presented to the group a little bit ago in the polls, and how what do you need to know to convert opportunities? And the majority of you responded that you need to know what the problems are so that you can help solve them. And the good news is that information is out there. One of the answers to that is what Eduardo just showed you, is the procurement forecast. That is the government's way of saying, these are things that we need. This is the thing or the service that we need you to provide to us to solve whatever problem we have. And there are some other resources out there to help you understand what the government needs and how you can help fulfill their need. So some of the things you're seeing on this slide here is the contract awards page that gives you an idea of the contracts that were awarded. Chances are, if we needed it once, we're going to need it again. So, you know, check back with Emma to see the next time we're going to be procuring those goods and services. Speaking of Emma, that is your primary resource for learning about contracting opportunities and understanding what the state is buying. Just keep in mind that state regulations require that any state agency purchasing an item or service valued over $15,000 must be publicly advertised in eMaryland Marketplace Advantage. So that's a lot of opportunities that you can learn about there. And then as far as when you're looking at some of the smaller procurements, on the website that Eduardo was showing you, the Governor's Office of Small Minority and Women Business Affairs, there's a small business liaison list and a minority business liaison list. Those are points of contact within each of the organizations throughout the state that can really help drive you and help you understand what opportunities are out there that may fall under that $15,000 threshold. And then you can take a look at some of the other resources. Russell's going to send the slides out to the group after the presentation. Within this slide, everything you see in blue is a link so that you can access the resource that I'm speaking about here. So again, just keep in mind that a lot of information is on our websites, whether it be the Office of State Procurement at procurement.maryland.gov, eMaryland Marketplace Advantage at emma.maryland.gov, or the Governor's Office of Small Minority and Women Business Affairs. And I know Eduardo already provided that to you in the chat. I will also provide those links that I just mentioned in the chat so you can access them as soon as this presentation is over. Great. So thanks, Russell.
Thank you. So I'm going to stop sharing so that Kirk can pull up and share his presentation. So we gave you a taste from the macroeconomics. So Tim talked about different things what the market's doing, what inflation, what the Fed is doing. Eduardo talked about how to find opportunities at the state, just as an example. Kristen got a little deeper. So these are all the macroeconomic information. Now, applying all of that information. So Kirk, you want to begin showing how to use all this information.
Yeah, we got what, like 40 minutes here, Russ, to get this in. So I'm gonna do the best I can to lay out, the habits of profitability, which are those, those skills that Russell's talking about. And, I'm listening to what's going on here. I mean, Maryland is ready for business, and if there's more infrastructure, there'll be more contracts for folks. And I may look old, but I was not around in the 1940s when we had that post-World War II expansion that Tim is talking about. But it sounds like, going into the third quarter of this year, it's game on. And so the habits of profitability will give you CEOs, more skills about how to really make use of what's here. To wrap up, I have a questionnaire. I'm going to set the stage. We're going to talk about the habits of profitability. And then at the very end, I have a resource to offer you where you actually score certain aspects of your business to see where there might be some additional opportunities or options. So to kind of to set the stage here, let's talk about who the players are. One of the things that I hear quite often is role confusion. Why can't my accountant do that, or why can't do the tax preparer work or GrowthCFO? So there's to kind of straighten things out here. There's 3 key roles for most small businesses, and that's tax preparation for compliance. It's the accountant who's recording transaction, billing customers, collecting money. And then it's the GrowthCFO that gives us that forward-looking view of, based on what we think is coming, how do we position ourselves to do the best we can in those, with those opportunities that were just talked about. And so, a lot of times CEOs, you hear this frustration. They keep asking their accountant or they keep asking their controller to do something. And no matter how many times they ask, no matter how much clarification they provide, the accountant just doesn't get it done. Or when they do it, it's very, administrative. It doesn't have the, that Spitzgefühl that a CEO needs to run the business. And, lots of time that's when there's certain analytics being done. So we distinguish between the difference between a growth CFO versus a traditional CFO, where a traditional CFO might be consumed by the plumbing of the business, accounting, treasury operations, things like that. A lot of times they're challenged to really look forward. They definitely don't challenge the CEO, instead of going 3X, what about figuring out a scenario where we can grow 10X, right? To really go for it and do well by doing good. Most traditional CFOs are actually controllers, right? They come up through the accounting side. Some are financial planning and analysis. They can get you as far as getting the budgets and getting cash management, but they're not skilled at that full journey, where a growth CFO can take you from foundation all the way through those 7 succession options that we were talking about earlier. So in our businesses, like Michael Gerber, eMyth, if you don't have a true growth CFO working side by side with you, you are the CFO. So it's just another hat. It's part of that whirlwind that we get caught up in. So think about having the right team members. Building off the growth CFO, the role, what does a growth CFO do for CEOs is we establish the habits of profitability. We learn and we use the habits, and that the habits are those basic controls. If you're flying an aircraft, where are we at? And then what is that flight plan on where we're going, and how do we know if we're hitting the right checkpoints or not, right? So that's part of that preparation that Russell was talking about. Before you get in the fly, you checklist and flight plan. So the 5 habits, the first 3 are that block and tackle, and then the habit 4 and 5 are more advanced on how to really drive the maximum outcome for your business. So habit 1, I'll briefly go over the 5 habits. Habit 1 is using the monthly financials like a scoreboard. So it's not an administrative exercise. It's something that you get your P&L managers involved with, where they know the number story, they understand the variance, and they identify what action to take to get back on course or to take advantage of an opportunity. Habit 2, this is managing cash well, where it's that short-term view. On that 12-week cash forecast, how do we move around the timing of payments so we make sure we got more money coming in than going out. Habit 2 also includes how do we achieve positive cash flow, right? This is where a lot of financial professionals don't get into, beyond the basic management. Can we actually change how money comes in, and how does that impact not just the cash in my business, but the value of my business? A business that uses less cash is more valuable. Habit 3.
So this is where, some of the things that from the macroeconomic standpoint that Tim briefly went through could, when it comes to looking at what the Fed is doing, looking at what's going on in the stock market, that could, applying those lessons learned into how you're managing your cash, because it could change in different economic cycles.
Yeah, most definitely. So habit 2 is all about keeping cash right, which either creates a go or no go situation. So then habit 3 is where it gets fun. I mean, this is where, some people might say budget, but budget doesn't sound fun. But a 12-month rolling forecast where we're running scenarios, doing the what if scenarios, to engineer profitability. And it's not just the CEO doing that, the managers, team members are doing that to figure out, given our options, what is the best way forward so that the money lines up with our, our go-to-market and our operational plans as we're building that capacity. And then habit 4, let's get our heads, above what's going on inside the company, and let's look at the value of our business compared to other, businesses in our industry, kind of like what you do for your house, right? So what is our valuation, and how do we compare to our competitors in the marketplace? Because if we're in the top 20% and we can defend that, just a different world of possibilities open up, as far as getting access to cash and things like that. Habit 5 is you going beyond the numbers. What are the 8 drivers that we can develop where we have a more valuable business, and the business is transferable because it's not dependent on us, and we're able to get paid twice, beyond the household income we earn. When we transfer the business, we get that second big check. And if we work with Tim, you get to keep more of it, so you don't want to cut a big check to the government. So those are the 5 habits. Russell, do you want to pull the group and kind of see what habit folks are most interested in going into?
Yeah. So looking at these habits, looking at getting prepared. So what do you need to be focusing on? Understanding the numbers. I wish we could dive into all 5 of these in detail. The presentation I'm going to send to everybody does, but in the time we're going to be looking at just one of these 5. So a couple more minutes for everybody to vote. So habit 1, looking at those numbers, all right, for your business. A little bit on the macro, what's going on, but this is really looking at the micro, your business. Managing cash flow, again, taking some of the principles going on, creating that financial roadmap, habit 3. Habit 4, driving performance, and 5 is identifying the right option using those 8 drivers. So I'm going to share. So Kirk, we have habit 5. So if you want to show people the information on the 4th one, but dive deeper into the 5th habit. Oh, I haven't shared the results.
Yeah.
Okay, so we're a little heavier, 32% on the 5th habit. Show the resources for the other 4 as well.
Great. So habit 5 is the developing those 8 drivers. So I'll go right there.
Okay, so these are different resources.
Yeah, for each habit, kind of what the essence of each one is. Okay, habit 5, that's the one you want, right, Russell?
Yep.
Okay, so habit 5, this is going beyond, again, that traditional CFO role. Like, what things really matter in our business? What qualities should we develop to make the business, one, easier to run today, so it's not all dependent on key employees, the owner, customer concentration, that kind of stuff. And two, when the business has fewer dependencies, it's transferable, right? There's 7 succession options, and all of them need some capability to transfer the business to another person who can come in and really do well. And then because of those factors, more profitable, transferable, there's less risk in the business. That makes our business more valuable. And I'll show you how much more valuable in just a moment. And all this is based on pretty extensive research. It's based on 34,000 private companies. So we have a good footing to stand on. Let's kind of break it down. There's a lot here. You could probably do a webinar on any one of the topics and still just begin to scratch the surface. But for our standpoint in this event, we want to get us to the point where we understand what it is and why it's beneficial. Then if it's something you want to bring to your business to be playing at that 2% level, these are the things to come to. So it makes sense. Owner's trap, right? This is just sheer dependency. And they ask a test for the owner's trap to see if my business is dependent on me for key things like selling, delivery. It could be employee management, right? It could be I'm the key point of contact for clients when they want to discuss their different things. If that's the case, I'm the bottleneck. I'm the constraint, right? If I go on vacation, there's certain things that slow down, maybe even stop while I'm out, right? So those are all symptoms of the owner's trap. So kind of clicking through, some of these will be more intuitive, like recurring revenue. Why is that better than project revenue, right? Recurring revenue is more predictable, right? It doesn't start and stop like a project. Even a multi-year project, at some point, it's gonna stop. And even in government contracting, it seems like we get contracts for a certain number of years, a couple of extensions, and then it goes to somebody else, right? So what does that world look like? The project world versus building some base, maybe all the base of recurring revenue. A uniqueness, can we measure the uniqueness factor in our business, which makes it, you start to attract different options, price premium now for profitability, but tomorrow when you want to step back from the business for succession, you got, you could attract strategic buyers, maybe multiple strategic buyers, which drives up, that big check that you're looking for. Where do we have growth potential in the market? That's probably a good thing to look at now. Federal contracting, state contracting, the commercial world. So these drivers, if you have growth potential, your business is more valuable. Russell, how far down do you want to go into this? Because it's, the 8 drivers, we do have, we kind of illustrate some things on the owner's trap, right? And likewise, growth potential, which is quadrant, do we do, the quadrants are, do I do new things with existing customers or new things with new customers? So you can evaluate the marketplace. Where do we have the most opportunity to figure out, what we get into? I'm gonna show, just kind of looking at time here.
So yeah, keep going into
Yep, the attendees wanted you to go through the 8 drivers here. That's what some of the questions were.
Okay, so let's stay with that. And I have a report to show you in a moment that explains all 8 drivers. Let's go back there. So customer satisfactions, people may have heard of the Net Promoter Score. That's that simple question: where do you rate us from 1 to 10, right? And then based on your outcome on the Net Promoter Score, how do we compare to other industries, right? Amazon is like off the charts, Google is off the charts. But where do we stand? And that's another way of communicating. One, when you measure your customer satisfaction on a certain frequency, it helps the leadership team know where to drill in. And two, again, we're talking about selling our business where this conversation started. If you have a measured result over a period of time, and you can show what your delivery and customer service team is achieving, it's just much more defendable than the conversations when you're talking to a prospective buyer about your business. Financial performance. I mean, this is kind of the foundation on this journey. Are you using the right accounting system? Do you have a professional accountant who's driving that system to make sure that things are tied down? You'll hear accountants talk about reconciling the bank account with the general ledger, that kind of thing. That's just make sure everything is accurate. The next step above that, having the system, the right accountant, are the financials either reviewed or audited by a third-party CPA? Because a third party comes in and tests the financials and the controls around them to render their opinion on are the financials accurate enough to be used to make decisions. That gives a lot more credibility, right? And definitely, if you're going to do something strategic, do your audits at least a couple years early, because for sure there are going to be things that the auditor finds in your financial operation that they recommend changing, and you want a couple years to get that done, so that when you go to the marketplace, you get literally a clean set of books. We talked about dependency. I mean, are we a people process driven company, or do key people have the know-how in their head, so that the minute you hear that knock on the door, you know that part of your intellectual property, part of your capability is about to walk out the door, because that person took another job or is going to do something else, or might even be retiring, right? So any of those dependencies, employee, if you have customer concentration where any customer is responsible for more than 20% of the revenue or profitability of your business, suppliers, we saw a lot of that. A lot of people sole sourced either in China or Mexico, and what used to work became a real issue and still is an issue in a lot of industries. So maybe it's a little less efficient, but supplier diversity, local, maybe international, it should at least, as an option, at least assess that for your business if you're doing that type of work. Positive cash flow is what we talked about. Can we get positive cash flow? Is basically getting paid before you have to make payroll and pay rent. And these are the companies that are getting prepaid, getting a deposit. That's positive cash flow. A lot of us can't get all the way to being positive, but how far can we go? If we can reduce the average number of days that our sales are outstanding from 45 down to 15 days, you get from a working capital requirement, you got a whole different equation going on. So now you got more fuel to scale the business.
The two, Kirk, that we're going to pick two to dive deeper into. So if you could, the recurring revenue, I got the top vote, and the next was the growth potential. So if you could dive deeper into to those two, not to say the other six aren't important, but diving into those two, recurring revenue and growth potential.
Okay, great. I'm going to pull up. I'm going to pull up the report that shows what they get if they answer the survey. Because that gets into recurring revenue. There's something like 9 different models. So quick overview. This is a report. When you take the survey, it takes about 12 minutes to answer. And
it's at no cost to you. I just want to emphasize that.
Yep. It gives you a custom report based on your responses to the questions. As much as possible, plain English, because CEOs are normal people, or not accountants, not CFOs, so it's in plain English, but it will explain some fundamental concepts that are really useful to us in making decisions on how to grow our business. So recurring revenue, you see growth potential, it'll get there. Let's kind of talk about let me get positive cash flow. There we go. Okay, so recurring revenue, this is the stuff that's predictable. the best example that comes to mind is a phone company, right? Where you have a certain client base, and then there will always be some churn. You'll lose some percent of your clients, every week, every month, every day. But then based on your go-to-market plans, hopefully you're adding more than you lose, right? So that every month I can kind of predict what that outflow and inflow is to get a net result of forecasting forward. What do I expect, given that every client is paying me a certain, more or less a fixed amount plus some variable amount, right? So it's very predictable. Think about that versus a construction project that might last 2 or 3 months on each project. It's pretty hard to manage capacity and sales operations, and then delivery capacity, then all the raw resources you need. If you're doing projects, especially short-term projects, it gets really hard. Long-term projects, even multiple years, they still begin and end, and there are gaps between one project and the next one. Sometimes they never come back. It seems like in some spots of government contracting, somebody else gets a turn, and then that original company is trying to fill a big hole. So recurring revenue, if possible, if all your revenue is predictable, is more reliable, a strategic buyer or financial buyer of your company will value recurring revenue quite high, because they can have confidence 12 months later that they're going to have some level of activity still going on. And there's 9 models, separate from the first questionnaire. The 2% CO score produces the score, a measurement for each driver, but then there's additional exercises, to really dive into, blow up a little bit. But again, give me the what and why. There's 9 models, and just by reading this and looking at what your score is for the recurring revenue model, you're probably going to have some aha moments. In the exercise we take CEOs through to create options, let's find 2, at least, maybe 3, and really run through scenarios where it might just work, and we might be able to blow up some status quo thinking. Doesn't mean we have to do it, but let's really do the work for 3, just to open up options, because what could that do for our business and ease of management. So this, in a nutshell, this is kind of what it is. Kind of keep an eye on time here, Russell.
Okay, if you could dive into looking at the other one, which was the growth potential.
Yep. The growth potential is back on the main. Okay, so this is growth potential, and there's a series of questions you'll see in that report. There's really 5 questions, and you answer questions about from a marketplace, from your clients, and you're looking at your marketplace from existing clients versus new clients, right? And obviously, new clients are riskier than existing clients, so it's going out on that quadrant. And the same thing with products on the horizontal axis. Where what we have as far as existing products versus new products. And then from this, the questions produce a discussion that most leadership teams haven't had. So there's moments of clarity, and there's what could seem kind of like the fog of war, not sure what to do. You start getting a short list of what makes sense for us. And it could be the low-hanging fruit, the lower left, where this is the place for us. Or there could be a reason to go upper right, where the marketplace we're in is being commoditized. We need to get out of that, and potentially, like in a sudden change like the pandemic, people move real fast. With the type of client they had at one moment was very different the next, and people took services, even food services, and productized it into something that could be delivered at home. So depending on what's going on, the growth potential starts to give CEOs and their team a meaningful way to assess the marketplace.
So in using this evaluation, what you want to do is not start with the high risk. Don't look at finding a completely new market and new product or services. So you want to be looking at your markets, existing markets and existing product and services, and see if you've exhausted all of that.
Yeah.
So looking at existing customers, you know, all the time I get people that say to me, well, those past clients of mine, they know what I sell. If they need me, they'll contact me. No. So you need to reach out to them. So that would be existing markets, offering them what you have existing. So that would be the lowest risk.
Yeah.
In communicating with them. Then you have the new markets, right? But existing products and services. So be looking at those, but also be looking at existing markets. You know, McDonald's, you know, got people to, you know, in a 6-word question, would you like blank with that? So that's existing, but then look at, okay, what else could people want to buy that are standing in front of me? So that got McDonald's to be looking at salads and chicken and things like that. So start with the green. Then you have your 2 yellows. So you got to make a judgment call. And this is where you can take some of the macroeconomic information that Tim looked at, some of the things that Eduardo looked at, some of the talked about, Kristen talked about, just using the state as an example, looking at new markets. Should you go into that? Or should you go into new product or services? So making the judgment of which to go next, and then you go to the other medium risk, and you leave the high risk to the very end. Hopefully you don't need to get there. New market, new product and service. But sometimes you may, but leave that to last. Get an old-fashioned whiteboard out, piece of paper, and put this out. It's amazing, Kirk, how things always work out great in our heads. But when we lay these out on paper, it doesn't. Can you show, and I think it was under habit 2 or 3, going to the 90-day sprint?
Yeah, just a bit on what you laid out here. What happens is you come into a management team. There's lots of different ideas. Most of the time, people want to do the new clients, new products. You know, it's frontier, it's more exciting. But by having this discussion, which this exercise facilitates, all of a sudden you get down to, you know, focus. What 2 or 3 things can we do and do well? You know, I say, should we do to really drive the outcome that we need this year for the business? And it gets at this point, you know, it's that clarity, and then, you know, it's just the follow through. So you want to look at the 90-day sprint now? Is that?
Yeah.
Okay.
So again, you're going to get copies of all these slides to go deeper in each one for yourself.
Yeah, this really ties into what you teach, Russell, where it's that 12-week, you know, planning cycle. You got your multi-year plan, the full year plan, but bring it to that 90-day sprint. What is your objective? You know, stated, clear objective, measurable, right? That at the end of this 90 days, where do we have to be? And obviously bring it back to weekly key performance indicators so that you can proactively make adjustments as a leading indicator versus, hey, the 90-day sprint's over and this is what we're left with. So, you know, so really being hyper focused again, 80-20, what's going to move the business based on the objectives that we care about. Assessing those options, kind of what we talked about, like growth potential. Let's have the broad look and then bring it into the narrow items that will move the dial. So now we're being intentional. We're using the numbers plus what the managers, you know, qualitatively know about the business, and then based on, you know, what options are chosen, what's the right team, and using, you know, disciplined project management to follow through. on what the plans are. So that's that cadence, 90 day, within that 12-month plan, really get detailed at that, that 12-week, 90-day sprint. Russell, you have a piece about this where you throw in the extra week that gives you kind of.
So I call it personally, I call it a 12-week action plan. So looking at identifying what you need to do each quarter. So having a year plan, outline it, but specifically get to what you need to do, what your employees need to do, what your subcontractors need to do in the next quarter. So Kirk calls it a 90-day sprint. I call it a 12-week. So how many weeks are there in every quarter? Well, if you look at how many weeks there are in a typical month, you say 4, and there's 4 months in a quarter. So that's 4 times 3 is 12. So in actuality, there's 13 weeks in every quarter. So if you take 52 divided by 4, that's 13. So what I tell people is manage your business on 12-week quarters. That gives you 1 week off per quarter, 4 weeks off per year. And that is helping you with not having the business dependent on you, not having it dependent on other people, and starting to get you out of that owner's trap, and then start reducing that next year. It could be that you're managing a business on 11-week quarters. So I introduced this concept of a 90-day sprint to Kirk. So Kirk, you want to share your outcome of it?
Yeah, for us, I'll combine that, the 90-day sprint, combined with a weekly KPI, because for a long time, Russell taught and advocated weekly KPI, but I'm a growth CFO by nature. So I'm like, hey, with the monthly financials, we got what we need. And learned the hard way, right? There's decisions I could have made in 3 weeks if there's a weekly KPI that literally took me 3 to 6 months just to look at the monthly financials. So it was Russell with the weekly KPI in this context of this 9-day sprint that really opened things up. And if you do a 12-week planning cycle, then literally you get 4 extra weeks as kind of you're hedging your bet to to hit the goals that you're looking for. So it's a powerful combination. Planning across a monthly cycle is too short. 12 months is too long, but that 90-day, that 12-week cycle, it's right there in the sweet spot of what's doable for most managers.
Okay, so I'm going to send out mine. It's a very project management approach. It's looking at what action steps you need to do. So it starts off yearly. So I'll put if anybody wants for me to show, just like I did with Kirk, how to utilize it, I'll include my calendar where you could set up a time. Again, I call it a 12-week action steps. Kirk calls it a 90-day sprint. Same thing.
Mm-hmm.
So in the last couple of minutes that we have, because 86% of the respondents, let me share this result. They don't have a 90-day. So I encourage you that this is, if you haven't taken anything away so far, and we're just halfway through it, we're going to get into the HR side in a minute. But having that 12-week action step, looking at the habits, applying those and applying different aspects of that over the next quarter.
Yeah, makes a huge difference. I mean, full disclosure. I mean, I made a decision to terminate one of my partners, literally because of that weekly KPI. I mean, when you get red and big stories, it gets a lot easier, and everybody knows, right? There's no surprises. It's like having a performance review every week, and if something's off, just roll up our sleeves and get it back on track. But if it's off forever, not a good thing.
Hey, in the 4 minutes we have left, what's the final thing that you want to emphasize that needs to do to manage profitable contracts?
Yeah, so what I'd emphasize, I mean, definitely put the habits in place, but a smaller first step, right? Putting the habits in place, so to understand will take a minute, but a smaller first step is do the questionnaire to get your 2% CEO score that measures these 8 drivers, and that alone will give you some aha moments. You look at the explainer report that's based on your score, your responses, and for sure you'll get some aha moments where you have more clarity about what's going to really help you run a better business. And we know for a fact, literally based on that database of 34,000 private companies, if you're scoring, the average company, from a valuation multiple standpoint, is doing about 3.5, 3.5, 3.55 when they come in. When you develop the score to where you're scoring 80 plus overall, then it's on average, you'll increase the value of their business compared to your competitors by about 71%. So you'll get that 6+ multiple range. And just to kind of show from a real like money in pocket standpoint, for every dollars of earnings before taxes, that shift by having a better business that demands less of your time. So you're getting freedom of time. You're also getting freedom of money. You have the resources to do what you want when you want. For every $1 million of profit, you get another 3.5 of exit value, right? And short term, you got a better business, more profitable. You're playing to your strengths, your uniqueness. You got price and premium now kind of stuff. The score allows you to get the report. We use this internally. We measure ourselves twice a year. We're also offering. We started doing open office hours every Friday, but the real call to action right here is to, get your get your score.
Okay. So if you want to stop sharing your screen, Kirk, and share while I get my presentation up, is the one takeaway with all the habits. You have your 8 drivers, the 90-day sprint. What would be one takeaway that you would want every business owner to do in the next quarter to be more profitable?
So start with the basics. I mean, if you're not looking at the financials, look at them. Look at them with your managers to establish ownership for what they control. And it's like looking at a football game, soccer game, whatever it is. The monthly financial are the scoreboard. That's the foundation, and that align. No matter what people are saying, no matter what your intuition is telling you, the numbers align. Your teams across the company. So that's the most basic. If you're not already doing that, open up the P&L and teach your managers how to read them and how to use them.
So can you see my screen, Kirk?
Yeah, I can if I bring it over. Yeah.
Okay. So looking at access to capital, which is key with the habit with the cash flow. And this is where you put some macroeconomic standpoint. What's going on in the market could be opening up opportunities to get private equity money where things could be harder on the bank side. So this is just a quick checklist of the what bank and debt private equity wants. When you're communicating with a bank or a lender, you don't want to put them in a decision-making role. You want to put them in a consulting role, and say, this is how I look now. This is what I want. You never need money. You always want money. How do I need to look to get what I want? This is on the banking side. I have a similar one from an investment standpoint if you're looking for private investors. But you can see that banks, underwriters, and private investors, they're looking for the numbers. So that 20-page business plan, if you can't get it into 4 paragraphs under the description, you can't get it. So just a quick poll. stop sharing the results of that one. Looking at how you're looking at raising money in the next year. Are you looking for equity financing, selling that business, a part of it, bringing a partner, bank, refinancing, debt, self-funding? Do not need any money. Okay, just a couple more minutes on that. Okay. So for those from the bank government financing, here's a 2-page summary. So I'll send this out to everybody. Now, looking at from a risk management standpoint, kind of touching on with the financial side, a little bit on the banking, looking at managing your risk. We have Lee with us. Lee, are you back with us?
Yes, I'm back with you.
Okay, so just a couple minutes sharing that.
Yep, that's great. Thanks, Russell. Yeah, so I'm actually the property and casualty specialist at PSA. I handle all the my clients are retailers, restaurants. I specialize in contractors. Well, we also do human resources, which we'll talk about in a bit, and then group health. You know, what we find is having a good team is critical to your success. So when you have a good team, whether it be an insurance specialist or otherwise, they're going to see things that you haven't really thought about, and they can help you down the road and look out for your best interest. So as a broker, PSA looks out for you as your best interest. We don't represent the insurance company, we represent you. So that's also an important part of that relationship. Normally, you know, I do these in a 1-hour presentation. We're going to just squeeze it into about 10 or 15 minutes. If you hear some things for the first time, maybe you don't have a good team. So you need to ask these questions. There are certain risk management techniques that every business has access to. They could avoid the project, they could avoid what they're doing. You can transfer the risk to someone else, hire a subcontractor. And if you can't do those things, ultimately you buy insurance. So today we're going to focus on insurance. The first thing we're going to talk about today is we have an unusual situation going on, which we call a hard market phenomenon. And this is really the first time in 10 years that we've seen this happen. It's the result of worldwide disasters, things like severe and changing weather conditions, windstorms, hurricanes, tornadoes, floods. This past winter, we had ice storms affecting 41 states. Texas was really hit hard. And then on top of that, you have the insurance company defending claims against COVID, which they don't intend to cover because it's a pandemic, but they're spending about $9 billion to defend and deny those business interruption claims. And the bottom line is all these things drive up pricing. So insurance companies this past year have had loss ratios exceeding 90%, meaning they're paying out over 90 cents for every dollar they collected this year. This hits the reinsurance because all companies buy reinsurance as well. So the reinsurers are having the same experiences. They're raising the rates. They're making the insurance carriers retain more of the risk, which hurts their capital. They have to raise their rates as well, and then reserves. So what we're seeing, if we look at this chart of some average increases that we're having to deal with, I think if Randall can, or if Russell can pull that up, these were projected at the beginning of the year, and they're holding pretty steady. So the top line there is property. We're seeing about a 5 to 10% increase there, primarily from these catastrophe claims. On the general liability, average increases up to 15%. The umbrella, we are seeing major increases in umbrella excess pricing in commercial lines. So we're seeing those increases from 15 to 100%. And then auto around 10 or 15%. In the D&O market, a lot of claims there related to cyber and people either coming back to work or not coming back to work. And when we drop down to personal lines, which we don't really ever talk about personal lines, but you're going to see increases in personal lines as well this year. You're going to see your homeowners and auto go up 5 to 15%. If you're in a coastal area like Florida or any of those areas, you're going to see some substantial increases this year, maybe 25% or more. So these are holding pretty steady. So you need to be aware of that.
Why is personal auto coverage going up when people are driving less because they're not driving to work?
Yeah, so that's a great question. Number one, the insurance companies have invented this term called social inflation, which is the juries are now awarding more money in trials for personal injury. So that's one thing affecting it. But the other part is, if you've been on the road lately, you've noticed that people are driving really fast. And so fatalities are up. Even though driving is down, fatalities are up. That increases payments. And also it's becoming very easy to total a car. Technology has made these cars extremely expensive to fix. A bumper used to be $1,000. Today with the cameras and what have you, we're seeing those bumpers $5,000 or $6,000. And by the way, catalytic converters are now being stolen again due to the metal. So that's a new thing in the last couple of months. So it's other factors other than the drop of use. It's a great question though. But as we look at these, what are your strategies? So we know prices are going up. What are your strategies? Number one, control your losses. That's the best thing you can do with your current carrier and your current program. Get loss control from your agent. Call up your agent. What can he offer? Get it from the insurance companies. They all offer that to you. Ask your agent to shop early or get other agents involved. The ideal time is 90 days out. And ask for that pricing to be given to you 30 days prior to your renewal. So those are things that you can do today, either with your current agent or with other agents to kind of help mitigate these cost increases that you're seeing. The next thing we're going to talk about, cyber exposures. This is really hot. The cyber criminals, they have breached the federal government, the Department of Defense, major corporations. It's not a matter of if you're going to be hacked, it's a matter of when. And small business is the low-hanging fruit. This past year, we've had over a 45% increase in cyber claims. You've all read about or heard about the recent Colonial Pipeline ransomware attack. It's a new era in cyber. They paid out $5 million for that, which is an astronomical amount. Normally, when these claims would happen, they were asking for 25 or 50 or 100 or $500,000 PSA. We've paid a couple claims under $500,000 for our clients, but $5 million, that's huge. And in the scheme of things, that's going to be a drop in the bucket. They're already being sued. Colonial Pipeline is already being sued for not taking the proper precautions for their cyber protections. And every business affected by this is going to be suing them. So that's going to fall through to their directors and officers, their insurance program, and everything else. So it's a new era. There's also obligations like when you have information, someone hacks into your system where you accidentally release what's called PHI, protected health information. You might give out identities, credit card information on customers or your employees, payroll records for the last 5 years. These are all things that can be out in the dark web. And the law requires wherever the data originates is who's responsible for notifying and paying for credit monitoring for 1 or 2 years. So even if you send your payroll records to your payroll company, if they're hacked and they lose them, the federal law says you're responsible for notifying and you're responsible for paying for that. So one of the advantages of a good cyber program and a cyber policy is that you have a team of professionals. When you're hacked, you have a lawyer. First one that's going to talk to you is the lawyer, then a cyber specialist. And then if there needs to be a payment, the insurance companies already have Bitcoin accounts set up, and we can pay those within 24 hours. So this is something that is going to be on everybody's radar. The insurance companies are asking for things like dual authorization. They're really tightening up underwriting on this, and pricing is going up as well, at least 15%. So, be on the lookout for that. The other problem area we have, which really is a good thing this year, is workers' comp. We're seeing those rates flat for the most part. They have not been affected by COVID, but workers' comp covers the injured employee, and actually every state publishes a statute of what defines a claim or an illness and how much to pay for that. So the workers' comp pays the medical bills, the lost wages, short-term or long-term disability, and death benefits. It's based on the job description, which gives you a rate per $100 of payroll, and you multiply that times the payroll. It is audited at the end of the year. So if you've overpaid, you'll get money back. But what we see, especially happening today, as business starts to increase, you could be faced with a large audit premium at year end. So make sure you pay attention to your payrolls on the current policy and make sure that they're accurate. They can be changed at any time. For those contractors, there's a new code in workers' comp. Previously, we had estimators and sales employees under a code called 8742, which is salesperson or collectors. NCCI, which publishes these rates now, has a new code called 8720. It's for construction job site salespersons and estimators. It's a higher rate. This is a way for insurance companies to make more money, and they're going to tell you it's because, well, there's a bigger exposure, so we need to charge more money. But you need to be aware of this. If you're bidding projects in the future, make sure that you've taken into account that higher rate, or call your agent and ask them what's going on. COVID, for the most part, has not affected the workers' comp at this point in time. So that was good news there. And we hope that continues. The best thing that you can do for prevention is to continue to follow your federal, state guidelines at the job sites to maintain safe workplaces. The other big area that we have with workers' comp is subcontractors, or 1099. Anytime you hire these subs, you need to make sure you get a certificate of insurance from them and you keep that in file. Because if you don't, and their employees are injured, they can file a claim under your policy. And irrespective of that happening, at the end of the year, when the insurance company audits your workers' comp policy, they're going to ask you for certificates of insurance for any subcontractors that you hired. If you do not have those subcontractor certificates, they will charge you on that total cost as if that employee was yours. So those subcontracts are always a problem. So make sure you keep a file and that you have those ready for the insurance companies, because they will ask. Any questions with regard to any of that? I know we're like on the short term, but I tried to squeeze this into a short period of time. Our information is available on the website. You can reach out for me at any time. If you just say that you were on the seminar, my advice is free. So feel free to call. If you need help with insurance, obviously, we'd love to do that as well. Are there any questions?
Okay, so I'll send out your contact information for if anybody has any questions. So connecting, Leanne, Randall, are you on?
Yes, sir.
Yes.
Okay.
Yes.
So connecting from the financial side, the risk management side, and the people side, the image that you see, and I'm going to show a video in a second, is my daughter's last horse competition. So one of the key things in looking at your financials, people, as well as risk management, is what is the goal? So the goal is to jump the next jump, have the horse jump. The ultimate goal is to place. So she is doing a lot of different things to get the horse to jump. So watch this video. Okay, so this is her very last competition. Oops. So this is my riding. So remember what the sub goal is and what the ultimate goal is. Now, the rider needs to do a lot of things to get the horse to jump. I mean, one of the things that blew my mind is where the rider is looking. If the rider's looking off to the side, the horse will go that way. I don't know how. It all has to do with the body language. So the first thing that you need to do is to make sure that you're owning your actions. What can you do to reach that goal, that sub goal, and the ultimate goal? What do you need to do for your people to do it? But in Maya's case, in this case with the horse, her own instructor said, there's nothing that you could have done differently. Nothing that you could have done differently. You did everything correctly. So if she did everything correctly, who didn't? The horse. So what do you think my daughter did? She fired the horse. So in her next competition, which is actually this coming Saturday, or next Saturday actually, is she has a different horse. So looking at yourself, but looking at everything as an investment, okay? Property, your equipment, your location. If it's not working, you got to replace it. Looking at processes. If the processes that you're using is not working and you've done everything, then you need to replace the process. And then people. If you're doing everything, you have the goals, what they need to do, you have that action plan that shows what they need to do every 90 days, that 90-day sprint, and they're not doing it, then you need to what? Replace them. So one of the books I love is The Principles of the 4 Disciplines of Execution. And one of the points is that 70% of failures occur due to lack of execution, not strategy. So you could have a great strategy, people are not executing on those. So be looking at the things that you can do, the things in HR that you can't do. So here is putting the whole 4 disciplines of execution, and I'm going to send to you access to resources on the 4 disciplines of execution. Is here's a 3-sentence structure to outline, what is the goal, what is the ultimate goal, and what people to do in holding them accountable. Because if they're not being held accountable, they're not going to do it. So you could be having different conversations with people. It could be based on their performance. It could be communicating from a voice of affirmation of their potential. It could be how to clear the path. So you got to look at yourself, that clear the path part. But it could be that you've done everything that you need to replace. So you need to be assertive, not passive, not aggressive, but be assertive when you're communicating with people. One of the worst treatments of an employee is when they don't know where they stand every day. They need to know if they're winning or losing every day. So one of the key things of communicating is first to listen. I love this quote, is that we're given 1 mouth and 2 ears for a reason. You need to listen. One of the things that I was shocked with is a distractive word is when you ask the question, why? It goes back to when we were children and we broke a vase and our mother said, why did you do that? So ask how and what questions, get the same results, avoiding the distracted word of why. So when you're communicating, make sure it's clear, concise, compelling, consistent, and confident. So remember, when you're communicating, it's only 7% the words you say. It's 38% tonality and 55% body language. So if you just send an email, does that mean that tonality and body language goes away? No. It means that people are guessing what tonality and body language you were when you wrote it. So that's why if it's a key thing, send an email, but follow up with a voicemail so that they can hear your tonality in which you said it. You want to make sure that everything is congruent. Incongruency is why messages are not heard. So here's some other resources that I'm going to send you. I'm a big believer in Dale Carnegie. So there's a lot of resources that I'm going to send you access to, including how to make a presentation that Dale Carnegie has given. So, Leanne, Randall, you guys ready?
Yep.
Okay, so diving deeper into the HR, things you can and cannot do. Leanne, Randall, I have stopped sharing so you can share your screen.
Okay.
Leanne, you're going to share.
I am. Can you see the presentation? It looks like it's on everybody's screen.
Yep.
Great.
See it. Okay, great. Thanks, Russell.
So I want to emphasize, you first have to look at yourself. And they're going to be talking about what are the things that you can do and things you must do. So you have to do these things first before you go to the ultimate of replacing people.
Okay, great. So we're gonna cover HR considerations, people considerations, your human capital. Leanne and I are part of PSA. Lee Rock, who recently spoke a few minutes ago, is also part of our organization. He's an expert in the property and casualty world. I learned some things from him this morning that I didn't know yet. I always go to Lee for my questions. He's an expert on that stuff, one of the most knowledgeable that I know. Leanne and I are part of the human resources practice here, and we look at things through the lens of your people. So we're going to talk today about people considerations, how you differentiate yourself in a market that's competitive and that has burdens that you have to deal with as an employer, whether you want to or not. Government inspired, regulatory, external forces, pandemics, other things, economic cycles. So that's kind of the lens through which we're going to speak to you. I'm going to cover first things that you cannot control, and then Leanne's going to talk to you about the things that are within your control and how you sort of put all of that together to be a competitive employer from the perspective of attracting and retaining top talent. Go ahead. So this slide, the human capital management overview slide, is the world of human resources as we see it. This is everything that you as an employer of humans in today's world need to contend with.
I think there's 93 things on there, isn't there?
Something like that, yeah. 93, 94. If anybody's bored listening to us, you can count all the bullets and report back later. The way that this slide is laid out, you see that most of the items are in green. Those are the must-dos. You sort of have to get to those every day, every week, every month. They're the tactical items, from sourcing candidates, recruiting them, interviewing them, onboarding them, figuring out how you're going to pay them, what payroll system you're using, what frequency. Are you outsourcing the technology? Are you using something like QuickBooks? How you're managing their data. So most payroll systems these days come along with an HR system that you may or may not decide you want to purchase. That's one way to keep all the data in one place. Many organizations, particularly smaller ones, decide to kind of go bare bones on their technology. And so they're keeping data, which is really confidential and should be protected in other ways, spreadsheets, files, databases, et cetera. Lee touched on the cyber risk and the proliferation of that. And so, you know, protecting your employee data is one of the most important things you can do or you have to do as an employer. Then you've got other considerations like benefits, compensation, not just sort of what you're paying a particular employee, but how do you decide that? Do you have benchmark compensation data? Do you know what your competitors are paying? Do you know what these people are worth in the, kind of in the outside market if they were to be, looking for another opportunity? Do you have incentive programs? Are you sharing the wealth, so to speak? Or are you having these folks participate in the growth of your business? How are you training them?
So there's certainly kind of the compliance-based training, things that we really would recommend you must be doing, like harassment prevention and diversity training. But there's also technical training and other career development training that might be sort of more soft that you should be doing for your folks, or that they're going to want in terms of their own personal and professional development. And then global mobility. Are you dealing with people in multiple locations? We're going to talk in a bit about telecommuting and the proliferation post-pandemic of people being remote, probably not going away. So if you have somebody that used to work at an office in Columbia, Maryland, and they decided in the pandemic to move to Columbia, Missouri, and they're going to stay there but continue to work for you, you're now an employer in Missouri. Are you filed with the state? Are you doing fulfilling all your obligations in that regard? And then as you deal with all of those tactical items, you move up this pyramid into the purple and yellow or gold, which is the more strategic parts of HR. And how are you doing planning around your workforce? How does your growth strategy from a business perspective tie into what you're doing with your people, et cetera? Pretty complicated. And as you grow, this gets more complex. Okay, next slide, Leanne. So what are the things that are out there that you cannot control but are affecting your life? So we know that healthcare is a big spend. It's a big budgetary item for employers. It has been growing for as long as any of us have been around, any of us have been working. Healthcare trend is now about 6% a year. It was around 11% a year 5-10 years ago. So it's moderated, but it's still multiple times CPI. And the insurers operate in a different plane in terms of the increases that they're doling out each year. You as an employer, you're offering a healthcare plan, or you're giving people money through an ICRA or whatever to buy coverage. You're dealing with this. It's probably your second biggest budgetary item after payroll. And then there are all of the government layers that we have to deal with. We like this quote. We don't think this is a political statement. It's just a statement about the fact that government is in our lives. State, local, federal, there's multiple versions, and we have to all deal with them. The regulations that are listed here are just a sampling. If you kind of go from the bottom up, many of these have been around for a long time. FMLA, I will touch on that for 1 second. So there's the Family Medical Leave Act, which is federal. Many local jurisdictions, states, DC, some cities have now rolled out their own leave laws, paid leave for employees' illness, paid leave for family members' illness. They're all different. They all are funded differently. Some are employer funded, some are employee funded, some are a combination. You should be staying on top of those in your jurisdictions, either through your broker or through your HR folks, or however you're getting your compliance information. Something that we've dealt with in the last 15 months is the FFCRA related to the pandemic. We have, I think, a slide on this coming up. This was obviously a big issue last year as, certain people could not work. Infection rates were high. People needed time off to get tested. People needed time off to quarantine. We had many client conversations about scenarios, with regard to people being exposed or people living with people who were exposed. People tested positive, people didn't test positive, there was, as many scenarios as you could think of. That's what we were dealing with, and how all of these laws interplayed was a big issue. Now, obviously this is winding down, at least it seems for now. We're looking at a pretty, maybe somewhat normal return to normal summer. And so we're seeing less of this. I just saw the Maryland positivity rate today. It went down another 0.03. It's like 1.8 something. So, and the vaccination rates are up. So, COVID is becoming less of an issue in our daily lives than it's been, but complying with this law sort of, none of us in February of 2020 expected a pandemic, and then boom, we had one, and we had laws and we had regulations we had to deal with. So what's coming next? We used to, on this slide, have a picture of the former president, and we know that he wanted to repeal the ACA, and that didn't happen. And now we've got Joe Biden, and he's got several things, on his wish list. There's an infrastructure bill. There are tax implications of that. The ARPA, the American Rescue Plan that got passed, provides people that are involuntarily separated from their employers with free benefits under COBRA or state continuation through September of this year. Employers get reimbursed through tax offsets, their Medicare tax. But all of these bills have headlines, $1.9 trillion of this or whatever. And then almost all of them have implications, have pieces that implicate us in the HR and benefits arena. So I touched on the FFCRA. There's been the extension of that on a voluntary basis into this year. I'm not going to spend any more time on that because I want to make sure we kind of cover the rest of the material. We have a couple of slides here on telecommuting. So we talked about telecommuting when we would do these presentations with Russell leading up into 2020. And telecommuting was something that organizations, dabbled in, or it was prominent in their organization, or they didn't do it at all. And everybody could kind of evaluate it against, what we used to know as sort of normal work, where we went to an office or we went to a factory or whatever. And were the people that were telecommuting really working, or were they just kind of skating by at home? And did you provide them technology to have in their house? Did you pay for their Wi-Fi? And so on. It was really an exception. Well, it became the norm for most of us. As you can see, Leanne and I are both still in our homes. PSA's planning to reopen in July, and we're going to come back on a mixed basis where people can be in the office or not be in the office. We're gonna permit that. And many of you are dealing with the same questions. Are you bringing people back when they want? Are you bringing people back every day? How do you measure their productivity? Does where they sit impact their ability to get their work done? We were just on a client call this morning. The CFO of our client lives an hour from the office, and he's still working at home. And he's like, I don't want to lose 2 hours of work every day for me to, work in our financial system or work on spreadsheets that I can do from home, probably with fewer interruptions in a more concentrated way. So this is, if this isn't top of mind in your organization, I would be surprised. It's something that we're all contending with, and we are talking to clients about this every day. There's plenty of benefits around telecommuting, which we kind of touched on. We do recommend you have policies, very clear guidelines on what the rules are and how people mark their calendars and people's availability to attend in-person meetings, either internal or client-facing or sales meetings, how you're going to pay for their technology, their monitors, their internet. Do they need a separate room in their house? What about childcare? Can they telecommute and not have childcare? There's productivity impacts to that. I've been on dozens of meetings in the last 15 months with kids, with kids of all ages, five-year-olds, babies, dogs. I think we heard Leanne's dog at the very, very beginning of this. My dog will probably make an appearance here. How does that, we've all sort of been entertained by that, in the last year. Are we going to be entertained by that 6 months from now, or are people tired of it? These are all things that should be on your radar.
Cats are already tired of it. There was a great meme that had, dogs excited that everybody was home, and cats were annoyed that everybody was home.
I don't speak about cats, Russell. I'm going to leave that to you. So we do have a question for you, and Russell, what do we want people to do with their
So if
answers?
you want to put in your question, your answer to the question in the Q&A, so don't use the chat, use the Q&A. What are you planning to do with your workforce as the pandemic winds down? So type into the Q&A your response.
So I see 2 answers so far. Very consistent. So we'll give you guys time to do that, and we'll come back to this maybe a little bit later in the presentation. So far, it looks like hybrid is the common theme. We have a client Leanne and I are working with. They just basically abolished their office. I mean, they're going to continue to have a physical office for mail and certain meetings, and I think to have a presence in DC. They're in DC, but most of their folks are not going back into that office, and they've gone to an unlimited leave schedule, and they've gone to kind of work whenever you want. Now they do development work, and they deal with constituencies that are across the country and across the globe. So many of them were working sort of odd hours anyway, but they've gone to core office hours, I think of 10 a.m. to 2 p.m. Eastern time. As long as people can be reached during that time, they can do their work anytime they want. I would say that's an extreme. And a lot of their folks, by the way, have moved away from the DC area, and they're looking at geographic pay differentials as people relocate. So if you move to Nebraska, your pay might get cut. And if you move to San Francisco, your pay might get increased. And they feel like they're going to have an as effective or more effective operation with people working and using Teams or Zoom going forward. For other organizations, that would not work. So you're going to have to evaluate this, because employees, especially, sort of in-demand talent, which many people are these days, are going to have options. And if you're not going to be flexible and modern and accommodate them, they'll talk with their feet. Next slide. Again, I touched on this a little bit, safety issues, work from home in another state. You need to make sure that you're registering as an employer in the state where people are working full-time. And there's Fair Labor Standards Act obligations around hours people are working overtime, et cetera.
So I was working on a presentation, and somehow I injured my back. Now I'm working from home. Would I be covered under workers' comp?
Actually, yeah, good question. If you can show that it was in the course of employment, it would be covered under workers' comp. The insurance companies are concerned with this because essentially they're worried that they could be providing 24-hour accident coverage, that literally you could fall down the steps or trip over the dog and say that you were in the middle of the phone call. So the insurance companies will thoroughly investigate that claim and try to determine if it was in the course of employment, but in the event that it is, it would be covered.
So I'd have to prove that I was injured my back while working on a presentation. I don't know how I did it, but I twisted it somehow.
Yeah. I mean, you could have gotten up from the chair. Like, it doesn't necessarily require that there be an accident. So we have a lot of claims, especially for backs, where people are doing a job they normally do every day, and they twist or turn, and all of a sudden they've ruptured a disc. Workers' comp is in essence, ends up paying for those claims, even though it might not have been from an accident. So the answer is, it depends.
And again, you should have a detailed policy, and it should be fairly detailed in terms of the requirements and the rules, and we can speak to you offline about that. One thing that's super important, and again, we've lost a lot. We've lost pandemic forced us to lose the in-person, which many of us see as a real benefit of our jobs and our coworker relationships and our client relationships. We had the benefit of Zoom proliferating coming to the fore at, right, and Teams right around the time that we all got sent home last year. And they worked as a substitute. And they're a great way to keep in touch with folks and see them and not just have a phone call. Leanne and I saw each other 2 weeks ago at a work event. We had not seen each other in person since last March. We had to do a double take in the parking lot. I was like, when was the last time I actually saw you? Because we've seen each other so many times on Teams, but we had not been together in person in over a year. And we used to spend 3-4 hours a day together for 3 or 4 days a week, unless we were out at client meetings. And so really strange. Use technology to your benefit. All right, next slide. I want to get through this real quick because Leanne has stuff to cover. So, again, I touched on the fact that we hope COVID is winding down as the predominant thing on our radars every day, but we don't know. We don't know what's going to happen, a month from now or in the fall or in the winter. And, we might need to flex again. We might go back in person all the time, some of the time, and then be sent back home. The experts talk about another pandemic unrelated to this one. Who knows when or if that will occur, preferably, in my opinion, not for a long time. But you need to be able to pivot. You need to be able to put policies in place in writing and that you're communicating verbally. Vaccinations, I won't touch on this right now, but there's lots of discussion now about what employers are doing around vaccinations, mandating them, encouraging them, giving them on site, giving people time off to go get them. Masks, are you going to continue to have masks required in your workspace if people come back? How do you know their vaccination status? These are all considerations. We weren't talking about vaccination status 6 months ago. We were still talking about work from home and how people were interacting. And now we are discussing whether people need to submit copies of their vaccination cards, and is that protected information, and how does that information get submitted and stored in a secure way? So I'm going to turn it over to Leanne now, and she's going to talk. So those are all the things out of our control, right? Like we have laws, we have government, we have people that want flexibility, and then boom, out of nowhere, we have a pandemic. So let's talk about the things that make us, probably less anxious that we can control.
Thanks, Randall. Yep. So hi, everybody. As he said, I'll talk about some of the things that we can control from a standpoint of employers. First, whether you are doing it consciously or not, you are always reevaluating and re-engineering your employment deal when it comes to your staff. And they're probably doing it too. But from your standpoint as the employer, you're thinking about how much are you paying your employees? What are the benefits that you're offering them, if any? What are your hours? Do you have core business hours? Are you thinking of moving to something like that, as we outlined with a client that we work with? Are you developing people? What is it that they like about working with you? Why do they stay? These are all things that you're probably thinking about. And while you're thinking about them, you're going through a process of determining how you want to be viewed as an employer. So what are you prioritizing as the important parts or pieces of your employee package? And how much money are you spending on your staff and on who? So you probably have, depending on the nature of your business, you probably have different groups of employees that work for you. And are you covering and treating all of them equally? Is everyone in your company equally as important to the operation, to the business, as everybody else? Or are there some people who are more important than others? And I mean, to touch on that for a little bit, let's say that you have really talented and high-performing salespeople, and they're the ones that are bringing in the new business, they're bringing in the revenue. Are they just as important as the person who's sitting at the front desk? And maybe they are, or maybe they're not, but these are the things that you should be thinking about and determining if the people who are driving your business should have a little bit more value placed on them. And there are a couple of metrics that you see on your screen. You may already be tracking some of these. If not, you should at least be thinking about some of them. So for instance, onboarding, when it comes to recruiting, is there a specific time that you're recruiting? Do you have a lot of seasonal folks? Maybe you're recruiting a ton in the winter or in the summer, but not as much in the winter. Are you training your employees? And if so, how are you doing it? Is it just for new hires, or do you offer ongoing training for your employees? What about the technology? Are you sending out paper packets to new employees, or is all of your onboarding done electronically? You know, thinking about the types of employees that you're looking to attract, maybe it's millennials, Gen Z. And if you're still sending out paper, they might think that your company is a little bit out of touch. And that's not to say that you can't use paper documents. We have a ton of clients who still do, but you do have to think a little bit about how you're presenting yourself to the employees, to the applicants, and also to your customers. Then from a retention standpoint, you have a lot of different areas where you have leverage. So cash compensation, maybe you're providing bonuses, maybe there's commissions to certain employees along with their base pay. You also have benefits. Are you offering an employee benefits plan? Is it competitive? Do you have supplemental benefits? Maybe, you know, we have a client who just added a tuition reimbursement and a volunteer benefit to kind of incentivize their employees and retain them. Maybe you have a 401k. Are you contributing to that? Do your employees understand what the plan is? Is it automatic for them to enroll? All things to be thinking about. Same with employee programs. Are there other activities, picnics, holiday parties? Through COVID, we likely weren't doing a lot of these things, but as Randall said, now that we're entering summer and infection rates have been down, maybe these things will start up a little bit more. And then rewards and recognition. Are you publicly recognizing and rewarding your top performers for their contributions to your business? And then finally, commitment. You know, how satisfied are your people? Do they know what you do as a business? Are they ambassadors when they're out and about talking about your products? Would they recommend your business as a place to work? These are all questions that you should be asking your staff, and we'll talk a little bit about that on one of the next slides.
So if you can go back, Leanne, just for a second, you know, taking, you know, the macroeconomic standpoint that was talked about before, some of that information could be key as you're making retention strategies. So for example, the stock market is not doing well, and the only thing that you have as a reward program is a 401k that is all based on the market. So these are the things that, looking at the macro, to apply to your business situation.
Yeah, and there are other programs, you know, offering a sort of gain sharing program. So depending on how the company does, maybe the employees get some piece of those profits if you hit a certain threshold or margin that you've set. So there are a ton of different options of programs or platforms that you can implement to help retain and attract new people. So some other things to think about are from a benchmarking perspective. This slide goes into a little bit about external benchmarking. So where are you competing for talent? Are you all local? Or maybe now that people have been able to work remotely, there's more of a national market for the skill set that you're looking for. And those skill sets specifically, are they readily available? Are they unique and very specific? You know, we try to tell our clients to be very picky when it comes to the people that they interview and hire, because you want to make sure that it's a good fit and that they're not just going to start and leave in a month and then you're back to square one. There's a lot of talent out there. Some of it is mediocre, some of it is great, and you want to make sure that you're finding the right people. And then also, do you know what your competitors are providing? And if so, how well do you stack up compared to that? Compared to the cash compensation, maybe you have competitors that do have a higher base salary that they're offering, but you offer more incentives and bonuses, or maybe your health plan is a lot more rich or less expensive for the employees. Maybe you have a retirement plan that they don't have implemented, or there are special employee programs. And you want to make sure that whatever the total compensation is, that your employees understand it. We know if you have employees who are leaving over 25 cents or 50 cents an hour that they found somewhere else, but they're going to be paying, you know, $600 more per month on health insurance, they don't understand the total value of their compensation. So making sure that they do get the full picture. From an internal benchmarking perspective, you can get a ton of information by reviewing feedback from your own employees. And the best way to do that is just to ask. You can take the pulse of your current workforce. You can roll out staff satisfaction surveys, looking at areas of work environment, communication, leadership, the overall company as a whole. If there are specific areas that you'd like information on, such as benefits or pay, you can have a more pointed survey that doesn't, cover all of these different areas, but one specific area, and do a shorter survey that way. But the most important thing I'd say here is if you're going to roll out a survey, you need to be committed to acting on the feedback that you get. It can be extremely frustrating for employees to take the time to honestly and candidly respond to a survey and then see that nothing is getting done. We also know that you can't do everything. So really it's about determining or deciding where you want to put your efforts. There are some, starting with the low hanging fruit, the things that might be easily addressed, start there. There could be some management owned issues or maybe some employee owned issues. I have a client that from feedback from a survey, they started a committee on DEI. So they have employees involved in this, making decisions, helping with, different programs to be implemented. So again, just making sure that you're committed to acting on the feedback. And then I'll just get through this real quickly. I know we're short on time, but leveraging the limited resources. So putting all of the pieces together. It's not about having or doing everything, but determining what you're going to focus on. So we talked a little bit earlier about who these employees are and the different types of employees or employee buckets that you might have. And so we have 3 that we've outlined here. You have the first one, the ones who drive the business. These are the mission critical folks, those people who are your bread and butter, maybe the people driving the business, bringing in the revenue. Then you have those employees who are instrumental to the day-to-day operations, maybe the people who work in the back, turning the crank, they're the steady eddies. They're the ones who are keeping everything moving. And then you have those employees who are easily replaceable. They're not going to make or break your company. And the goal here is to attract the top talent, reward good performance, and that way retain, again, those good employees. But how do you do that? So we think one of the ways that you can do this is by differentiation. And we can see this in the investment that you're making in each group. And we feel that this investment should reflect the impact that they have on your business, but also the difficulty in replacing them. Because, we've probably all had that employee that it was the rock star. We didn't want to lose them, but we did. And then it takes months and months to find somebody to replace them. So each group likely has different total rewards components, as well as you see on the screen here, different base salaries. There might be variable compensation, maybe equity or supplemental benefits that are, allotted to certain employees. And then finally, you can differentiate yourself by career pathing. So we know that it's important to have an effective recruiting and interviewing process to get the people in the door. But then once they're there, you have to help plan with them. Where do they want to go? What do they want to do? What training do they need to get there? And can you provide that? So these are all different ways that you can get these people in the door and continue to retain them.
So if you can go back.
Yep.
So just to share a couple thoughts / quotes. One of the key things is that money does not buy happiness. Something that was studied and restudied by Harvard, Stanford, and others. Money will not make you happy. Lack of money will make you unhappy. So money will only make somebody to a level of contentment. So Zig Ziglar has different goal areas, and money is only one of them. So social, career, education, physical health, things like that are the other goal areas. So the other case in point is that a small business, if they are attracting people for money, they will lose people for money. They cannot keep up with that game. So you need to be competitive, be fair, get people to be content on the financial side, but then be looking about how you can differentiate yourself in those other 6 goal areas that Zig Ziglar talks about. And one of my famous quotes, really changing the dynamic from the industrial time point to the information age which you're in, because in the information age, people have choices. And a quote that I love is, you can buy somebody's back, but you can never buy somebody's mind. And in the information age, people have choices, more choices than ever. So you cannot buy somebody's back. If we're all labor intensive, you can buy somebody's back and say, go do the job, but we're asking people to use their mind, employees and subcontractors. So you can't, they have to voluntarily give that, and just reemphasizing what I said is that you're not going to win on financial. You have to be fair. It's the other 6 areas to be differentiation. Show how your business is contributing to those other 6 goal areas that people have in life.
All right, so I'm just gonna wrap up real quick. In summary, talented labor is always going to be in high demand. People are always going to want good employees. And the good people are always going to have options. If you are, highly talented, have a good work ethic, you're always going to have new options. And we want you to be prepared to attract and retain those individuals that we highlighted as in bucket 1, those who are driving the business. And that's the end of the formal presentation. We do have some contact information here. I know Russell will be sending this information out to you, but if you do have any questions on anything that we talked about or HR in general, Randall and I would be happy to speak with you.
Okay, so from an HR standpoint, what would be the one thing that you would say that small businesses need to do from either from an employee standpoint or a subcontracting standpoint? What is that one thing, taking all of it down to one? And if you can stop sharing, Leanne, so that I can share. Okay. So what's that one thing?
Never just one, Russell. Okay, so I'll answer. I see Leanne's thinking. I'll answer first. I'm gonna answer that with the assumption that the blocking and tackling is being handled, the compliance. Like, to me, that's like the price of entry. You're paying people, you're protecting their data, you're giving them a safe work environment. Those things are, those boxes are checked. In my opinion, then it's all about retaining and creating alignment with your top, most in demand and most important talent in your organization.
Okay, Leanne, what would you say is the one thing?
I was going to say it comes down to the employee level with, the group of staff that you have. We have clients who, for instance, I have one that they are always, it's a revolving door in this one specific role. And they fill the roles just to fill it for the sake of it, not making sure that it's a good fit, and it's not good talent. They're not a good cultural fit with the organization, and they leave, and they're always left in this situation where they're kind of struggling and understaffed. So I think taking the time to identify what works well with your company, the kind of talent that you need, attracting them to your organization, and then retaining them.
Okay. So bringing in the DEI topic, having a plan in this area. So it was touched upon, but looking at where you are, if you're not yet having your business to your employees is not having equality, you need to get to equality. But looking at moving through this process and having a plan on moving from having equality to equity to justice, and then having what's called from an agency standpoint. So also keep in mind, this is not only the right thing to do, but also there's more laws now on making sure that companies are compliant with these principles. So looking at having a plan, moving through and improving your firm, looking at the equality standpoint versus equity. So looking at having a process, having a project timeline, and I'm going to send these slides out to everybody, just emphasizing moving from one step from where you are to another step to another step. So here's some thoughts, and again, I'm going to send this out, of having a organizational assessment, an employee survey. So, Leanne, you talked about people that send out surveys and then they don't do anything about it. You want to speak more on that, or?
Yeah, like I said, I mean, it's hard for employees to put in the time and effort of trying to share their employee experience and the things that they like and the things that maybe they feel could be improved. And then it's seeming like the company doesn't do anything with it. We have a client that has gone through this, and after 2 rounds, employees felt, I don't want to even respond to the survey anymore because you're not going to do anything about it. But again, it doesn't mean that you as the employer have to tackle every single item that comes in. And you can put some of the onus back on the employees and get them involved. Like I mentioned with that one client, they started a committee for diversity, equity, and inclusion. And now they have the employees working on this with their leadership. So even if it's a little bit slow moving and getting results, they see that they're being taken seriously and that there is something going on behind the scenes.
Okay, so just going through, Leanne talked about, having an online survey and then having a focus group. I think you called it a, what do you call it? Committee.
Mm-hmm.
And then, having that report and implementing it, taking it to the next level. So I'm going to send out these slides that were created by Dottie Lee. So she has a whole team. So just as a resource for you, if you're looking at making that transition from having something, making sure that first step is that you have equality and you're moving through having more equity, then justice, and then the agency. Do you guys have anything, Randall, Leanne, do you have anything that you want to share on this point?
I mean, you touched on a bit of it here. I think that this is a really hot topic right now, and it's very important for employers. We see a lot of companies or clients who want to put in plans or evaluate how their organization stands when it comes to diversity, equity, and inclusion. And I think a lot of it does come down to, if you're going to implement something, emphasizing that the DEI initiative is a core value of your company and not just a peripheral task. This isn't something that we've heard about, so we're going to talk about it for a month or two, that we are adding this. This is one of our values, part of the mission of our company, to make sure that our employees understand or feel that they're part of a diverse group, that they're given the same treatment and opportunities as everybody else, and that we have a culture of inclusion, regardless of your identity.
Okay, so we covered a lot of different topics, all from all over the standpoint. So what I want you to do, as we're going to be still talking about more resources, is write down 3 things that you're going to take away to have more profitable contracts. So, from the macroeconomic standpoint, and I love using this analogy of looking at information. So picture sitting at your house, and you want to go to someplace. So one thing is, the goal. Okay, what is the goal? Make sure you have a goal. Now, there are those that go right out of their house to the car and start driving. They never look at a map. Okay, they never talk to anybody who's been there before. They don't look at the technology and utilize the technologies out there like Waze and things like that. So you need to take a pause, look at that map, utilize other tools to gain the information. It doesn't absolutely guarantee that you're not going to run into traffic as you get to your destination, but it's less likely that you're going to get lost. And how many wrong turns can you make in your business? Okay. Now, on the other side of things is those people that sit in their car, they stare at the map, they talk to people, they are so afraid to move and they don't. They have what I call analysis paralysis. So yes, you need to gather the information, you need to begin to apply the information, but a quote I love is you can't steer a parked car. You gotta take the information and at some point start driving and then navigate you around. That's why having as Kirk called it, a 90-day sprint, I call it a 12-week plan, getting specific of what you're going to be doing, your employees going to be doing, and your vendors are going to be doing, and your subcontractors are going to be doing in the next 90 days. So some other resources, Alicia?
Sure, thank you, Russell. And as always, it's always great to be a part of the CEO Accelerator programs with Russell Teeter and SBDC. In Prince George's County, we, like you all here, are talking about different pathways to growing a successful business. And I think all the presenters here today really did a great job of covering all those elements. You want to look at your employee situation. You want to make sure you're getting the right hires. You want to be looking at your insurance situation to make sure you have the right kinds of policies. You want to make sure that you're following your finances so that you're actually making sure that you're staying on track financially, right? Some people come to us and they're looking for a loan, but in the reality, if they can look at their own finances internally, they may not actually need the loan. It may just be other things going on in their business. So basically, we're pleased to be always a partner with Russell and this team of dedicated speakers from the governor's office and all of you here today that we're presenting and providing very good information, including looking at the world around you and understanding what that means to your business. That's why we encourage businesses to also be involved with their local chambers and also industry organizations. So Pathways to Procurement is a series that we're actually coordinating. We've been coordinating since March, and we have done programs with DGS, SCORE, our Office of Supplier Development and Diversity, and others, MBDA, lots of partners. Why do we care about that? There's billions of procurement opportunities. You learned a little bit about like some of the procurement tools through DGS, through Kristen and Eduardo from the governor's office today. And I just encourage you to realize that your federal agencies, your local, state, and county government agencies all have funding dollars to spend. It is a harder path maybe in some ways to go than just doing procurement with the private sector or academia. So you might want to look at different opportunities. But right here in Prince George's County, these are just some of our federal agencies: NASA, NOAA, Census, USDA. We have University of Maryland Global Campus, University of Maryland Campus, Bowie State University. So just know there are lots of procurement opportunities in Prince George's County, as well as throughout the state of Maryland. Upcoming Pathways to Procurement programs, we'll be working with Eduardo and his team doing a session in Spanish, June 1st. We'll be doing some other sessions with PTAC and also with SBDC, again, leveraging federal and state contracting certifications, selling to federal government agencies with the OSDBUs and small business liaisons, and marketing to prime construction companies. So these are programs that are open to all. And so we encourage you, next slide, Russell, to just reach out to join them. You can go to pgcedc.com/pathways. Again, my name's Alicia Moran, and I'm the manager of small business development. We have a whole team of business development folks here that have expertise in everything from manufacturing, construction, government agencies. My colleague David Lewis is on the line with us today. Like EDC, Prince George's County, all of your economic development agencies in the state of Maryland are here to support you. So if you are coming to us and you're in another county, reach out to your Howard County Economic Development Office or your Wycomico County Economic Development Office. But just know here in Prince George's County, we're here to assist our local businesses. I'd also encourage everybody to go to pgcedc.com and learn more on the calendar of events page. Is always good to check into, and actually register to get our newsletter, the Biz Buzz. And again, this applies to all other counties. You should get to know your economic development agencies because they're all doing great things and have been doing great things to support our companies throughout this pandemic and during this recovery mode, and thrive mode. So thank you very much, Russell, for having us to participate.
So a couple other resources. So this is part 8. So we have 7 other parts. So I'm going to, if you haven't looked at those, the recorded presentations, so I'm going to send those out, as well as a whole lot of other resources. So if you are not connected with the Maryland Procurement Technical Assistance Center on that, I would. So I'm going to send out their link as well. And also, in addition to the Procurement of Pathways, the Alliance for Hispanic Commercial Contractors have upcoming events at no cost. So one of the tools just on the contracting side, so we're kind of on there, is the Shipley model. So I used to have the whole book that I would send out to people, and I think they realized that I was sending it out to everybody. So I just have some resources. But that's something to work on of your proposal, having a business development, things to work on in the next 90 days or a 12-week plan. So if you need bonding, there's resources that I'll direct you to in my library on bonding that the Barber Group talked about. So again, a lot of different resources. We talked about a lot of different things. So looking at the next quarter, either if you look 90 days, 12-week, whichever model, what is the 3 takeaways from today that you can apply immediately in your growth plan? Be thinking about that, writing down if you want, put those in the Q&A. We'd love to hear that. I'm going to send out my contact information as well as my calendar if anybody wants to talk with me. So do we have anything in the chat? Any immediate questions? Alicia? Okay, so
I'm sorry, I was muted, Russell.
oh,
Just construction information for the contracting engineering. Okay, there's some very specific questions.
okay, so for the specific questions, then email. I'm going to email out so you can connect with me as well as all the presenters to get more information. Okay, with that, I thank everybody.